Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Monday, November 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we're in the midst of the Thanksgiving Day holiday week. The volume as the week goes on, generally speaking, will dry up. So tomorrow will be somewhat of a regular trading day. Today was somewhat of a regular trading day. The volume was light, but it wasn't terrible. It wasn't all that bad. We did have a little bit of movement, although the market from today's high to today's low was in a relatively narrow range. There was a little bit of volatility within that range, but for the most part, as the week goes on, the volume will dry up, the trading will become lighter and lighter. Wednesday, the volume is typically non-existent leading into Thanksgiving, and then Friday, the market is open, but again, the market will probably not trade all that heavily, not all that much. There typically won't be any volatility. However, the only caveat to that is if we get some kind of an event. We can always have an event, the unexpected, the black swan, whatever you call it. Could be a geopolitical event, could be something in North Korea, could be something out of the Middle East. Anything goes, so we always have to expect the unexpected. But barring an event, generally speaking, the volume will likely be light the entire week, and therefore trading just won't be that heavy. So that being said, let's talk about where we are and what the expectations are for this week barring an event. So we're above the moving averages, so the market did take that one dip down and close below the 20-period moving average last week, but we popped right back above it and we're right back in the saddle above all the moving averages, and there's nothing technically wrong with this market. The one-day wonder with no confirmation below that low the following day or any day following that tells me that the market is strong, the market is bullish, and normally this week is a bullish week. Normally the market is going to have a tendency to go higher this week. My expectation is without an event, there's a pretty good chance that by the end of the week we will have at least challenged, if not made, new highs in the S&P, in the SPDR, and that means a little bit around $1 higher than we are now. If you look at the high here from the 7th of November, the high on the SPDR was 259.35, so that's about $1 higher than we are now. I would expect, barring an event, that we will challenge those highs and potentially make a new high. Doesn't necessarily have to be a closing high, but we can certainly make a new high during this week. That would be common and normal market behavior to have levitation, I'll call it, during this Thanksgiving Day holiday week. Remember, the path of least resistance is generally higher with the market, and barring the volume, without heavy volume, the likely scenario is we move higher throughout the week. When you look at the IWM, look at the tremendous rally that we've had off the gap fill level that came in at 144.61. The IWM made that low down at 144.50 and had a rocket ride higher over the last 3.5 trading sessions, right back up to 149.53 on close today. And look where we closed. An important close today. If you look at this red candle high right up here, we closed above that red candle high today, pretty comfortably above that high. That tells me this market is bullish and it wants to go higher. And as you know, the IWM is my favorite leading indicator of the market. And that being the case tells me that if the market's going to follow, and it likely will, that higher prices are coming in the IWM and other markets across the board. So it's pretty cut and dry. We know that that red candle high is an important level for the IWM. We closed above it today. That tells me the market is bullish, and we should expect higher prices coming across the board. Looking over at the transports are still hanging down around this consolidation point. We did have a higher close in the transports today, up by 0.4%. And the fact that this general area is holding, and even we know that, if we were going to go lower, then we were going to go down to the secondary level, which was down here around the 200 period moving average. We identified that. And then we also identified another level if that wasn't going to hold, not too far below that. Right now, this level is holding. And if we get a rally in the markets during this week, which I do expect, again, barring an event, we should get a higher move in the transports as well. No mystery here in any of these markets. It's basically all the same market. They're all going to act and react, generally speaking, in the same direction, specifically in light volume during this week. If we start to get a rally in these markets, everything will float higher. A rising tide will definitely lift all boats. Tonight, I do want to make mention of the broker-dealer index, and the reason is because you could have made a case, and I did make a case a couple of times, that we could have looked at this in a couple of different cases as a bearish pattern developing for lower prices. We never did break the 50 period moving average, but what's more important is when you look over at the weekly chart, what do you see here? You see nothing other than a bullish pattern. We had a pretty big up move here, and we've just been consolidating in a bullish formation, never closing below the low of this weekly green candle, and higher prices are beginning to develop in the broker-dealer index. And you know what I always say, without the banks, whether it's on the upside or the downside, the market isn't going to follow. So if the banking sector, the financial sector we'll call it, if that's rising, the likely story is the other parts of the market are rising as well, and the market is unlikely to have higher prices without the banking sector or financial sector following suit. And the likely story is if the financial sector is having trouble and the financial sector is going downward, the likely story is the market's going to have the major market's going to have trouble rallying in the face of a bearish banking sector. And so what we're seeing is bullish behavior from a long-term perspective. This is also telling me that higher prices are coming. So all we've done here on the daily chart is have a long-term, since we made a top here on the 6th of October, all we really did was have a long-term, month and a half long pullback to sideways consolidation, eating time off the clock, building energy for higher prices. Now we're once again, with a strong day today, above all the moving averages, and like I just showed you on the weekly chart, it's a very bullish picture in the financial sector. Specifically on this chart is the broker-dealer index. Now, looking over at the gold market, we saw quite the reversal today in gold. We basically painted the candle from Friday that was a big up move, and what we talked about on Friday was the release of energy out of this bearish pattern to the upside, and we were not able to fill the gap at 1303. They came close. In fact, the high was 1297.50 on Friday, and we ended up painting that candle on the downside. And when I use the term painting, it's basically the same thing as saying we reversed the up move from Friday with a down move today. This is a reversal candle, not on tremendous volume, but just looking at the candle and the picture on the chart, that's a reversal candle. Are we going to head lower? The jury is still out on that. If we had a high volume reversal day, I would suggest that was the likely story, but we're still above the 200 period moving average. It's still could have been today a one-day wonder on the downside. And remember, we're trying to cue each of the metals markets, and two in particular, the gold market and the silver market. We're trying to cue one off the other. And right now, we started to see bullish behavior develop in the gold market out of a bullish pattern in the silver market. That was last week. Now, all of a sudden, we're seeing a possible reversal in the gold market. This is really telling us that the market wants to go lower. It really wants to play this bearish pattern out. And when you look over at silver, we had a nice big down day in silver also on some decent volume. And we have still yet a bullish pattern, technically speaking, in the silver market. As long as we don't close below the low of this green up candle down here, then this is still technically in a bullish formation, and we could have higher prices in silver. So what's the net? What's the end result, or what's the forecast, if you will, in the metals market? And the jury is still out. We have divergence. We still have a bullish pattern, technically speaking, in silver, and in gold we could have potentially failed. Real quick, going back to gold, this was a failure of a bearish pattern on Friday, and we could potentially be having failed the failure today out of that bearish pattern. So that kind of puts the bearish pattern back on the table, in my opinion. And what I mean by failed the failed pattern is, generally speaking, so let me just go back for a second, because this is a good chart lesson. So we had a bearish pattern, right? And we have a bearish pattern. And this will generally play out to the downside, down to our $1,248 level, wherever that actually is. And the 1,248 disappeared off my charts because I'm on my portable system on a little bit of a vacation. So anyway, the bottom line is that, generally speaking, this pattern will play out to the downside, down to what I have calculated at about 1248, 1250, 1248, in that neighborhood. However, the energy that would have normally been released on the downside looked like it was going to be released on the upside, and at minimum fill that gap at 1303. Well, we failed came short of, I should say, we didn't fail. We came short of filling the gap on the upside, and now we're right back where we were from Thursday, where we had this little doji candle down here at the 20 period moving average. That's basically where we are right now. So if you just take away Friday, nothing happened, and we're right back where we started from a couple of trading days ago. So where do we go from here? Well, the jury's still out, and we really need more evidence. There's no clear picture in my mind of where gold and or silver are going to trade over the next trading day or two. We need more evidence. We're in the middle of a range. It's not an easy market to trade right now, going back and forth one day after the other. That's a difficult trade. So we just want the picture to clear up. Let the market trade itself out. Let it be. Let it put in some kind of a pattern, some kind of a signal that's telling us what the likely story is. Without that clear picture, without that clear signal, there really is no trade in gold and silver. Back on the chart of silver real quick, when you look at today's activity, you're down almost 3% today. That's a pretty big down day in the silver market. That may be the silver market's way of trying to tell us something, but we still need more of a clear picture that we just don't have. If money is coming out of the metals, and if the metals can sometimes be determined to be a fear gauge of the markets, when there's fear in the markets, money typically will run into primarily the gold market, but also silver tends to follow. And if that's not happening, that may in turn support the case for higher stock prices throughout this week. And I'm just kind of coming full circle to what we discussed in the beginning part of this video about my expectation for higher stock prices into this week, or throughout this week, I should say. The crude oil market, crude was down a little bit today, about 0.5%, but we're above the moving averages, all of them. We had the big up day on Friday. There's really no change from the bigger picture. This is still, in my mind, a bullish chart. We could still come down and test some lower levels, but the bigger picture on the crude oil chart is telling me that crude oil wants to test the $59 to $60 area. It's not going to happen all at once. It'll get going when it decides to get going, but the trend is up, and that's the most important thing. You don't want to be short crude oil trying to fight the bigger trend. The trend is up until it's not, and right now, in my mind, until we really come down, if we did come down below this area on the daily chart and closed below here, that would be a negative sign. Until and unless that occurs, the trend is higher, and therefore I'm looking for that $59 to $60 area in crude oil. Now, if and when we do get to that area, I'm going to be watching very, very closely, because depending on what the market is telling us up in that zone, if it puts in a reversal up there, that would tell us generally, that would tell me that's all she wrote for the crude oil market for a while. However, if we can get some kind of, not can, but if we do get some kind of a super spike up and above that area, that would likely be the result of some kind of global geopolitical event, potentially in the Middle East or North Korea, or a combination of both, and that would present a different picture altogether. But barring that, I think 55 or 60, 59 to 60 is going to be a very, very heavily resisted point for the crude oil market. A lot of overhead resistance in that area for crude. Discussed that many times. We'll continue to discuss that. If and when the market gets up there, we'll take a snapshot and see what the market is doing, and we'll look for signs of a reversal in that zone. The bond market, not a lot has changed in the bond market. I'm still looking for the ABC pattern to play out. We have the A move, we have the B move, and we're, in my opinion, in the midst of the C leg of that move, and that would officially complete as long as we get above the high of the A leg. Doesn't mean that's all she wrote, just means that officially that pattern on the chart would be complete. But if we get above this area of the A leg, where this horizontal line is right here, then that would tell me, at least it would be the first indication, that higher bond prices are coming and lower yields are coming. Doesn't have to happen this week. We could go sideways for a while and build some energy in the bond market, building energy for another move higher. But that's what I see developing. There's no clear sign that we're headed higher right now, but the ABC pattern that I'm looking for should complete, and it should complete within the next week or two. And tonight we'll finish up as we normally do on the dollar. The dollar held the 93.365 level. That's extremely important. That happens to be the low of this large green up candle. We came back down to check in at the former breakout point, which was that low, and now we're trying to rally a little bit of an update today after a few days of sideways activity in the dollar. Could be putting in a bearish pattern here. That would potentially mean lower prices are coming, but as long as we hold a 93.365, we could see another shot higher, and that would really be significant in terms of this bullish pattern. We tested the low, we could go higher, and this could bring us all the way up to the $97 area. We would obviously take, or maybe not obvious, but in my mind it would be obvious, we would probably take a pit stop at the 200 period moving average. But if we shot out of this bullish pattern, and we've been consolidating for quite a while now, if we shot out of here, likely story is we would be headed for the 97 cents on the dollar area. And with that, it's everything I wanted to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.